I just wanted to make an announcement for Client Advisory Committee that you'll be starting at, I think, 4 to 4:30 is what Ed Durman said. So just so you know. So Client Advisory, the stakeholders in the room, Client Advisory 4 to 4:30, I guess depending on us. So let's go to item 4, Chris, with your CIO report.
Thank you very much. So a couple of the key stats that the teachers in the back of the room care a lot about. The first is the size of the portfolio. Back on April 29th, it stood at about $187.5 billion. Right now, we're touching about 188, just about. I think we hit 189, might have, around there. Obviously, we've got less than 20 trading days left to go in the year. It's a very tough year, but it's a great, again, a teachable moment. You know, I love those. If you look on that chart, the black or the dark blue line is where we closed last June 30 at 191. And where we stood at April 30 at 187, the average person would say, oh, they have a loss on the year. Well, the answer is actually we don't. Because remember, we discussed it. We have a negative cash flow of $6 billion net of investment income. So we would actually be able to drop all the way down to, sadly, 185. We'd still show a positive return for the year. So just you can think of when you look at where the fund is in size, the fact that we're above that number. You know, I can't predict what's going to happen in the last month, and it is going to make a difference. But right now we're squeaking out a very small positive return, similar to last year. You know, if you remember last year, the last couple of days of June actually made a difference in our return because this market can go up or down 1%. And I'll get into it, but obviously the biggest thing between now and the end of the year is June 23rd is the Brexit vote in Europe and or in UK. So who knows what happens there? So tough to predict what will be at fiscal year end, but I'll send you out an email and obviously we'll announce it. What I care about more is really the 3-year return. 1 year is, again, the pace per mile in a marathon. Could be uphill, downhill, doesn't really matter. The 3-year average right now will actually be above 7.5. But I will tell you, all of that is due to year one of the 3 years. We had almost a 21, 22% return. That's in the bank. Therefore, you can average almost nothing over the next 2 years, and you still average 7.5. The problem is, this is the last year we get to use that year. And so
We can't.
I'm always forecasting ahead. But, you know, right now when I look at next April or May, when you hear from your actuary, they'll come in and say, well, you're still kind of, you know, you're still ahead at 7.5 or still eating through that. But they will, when I look at May 2 years from now, I'm kind of worried because we would really have to post one heck of a fiscal year 16, 17 in order to keep up this pace. You know, last year was low single digit. This year might be low single digit. So there's a challenge ahead of us. We know it. We see it already coming. And just to be cautious for everybody. Here's the asset allocation. What I will point out to the audience is that the red bar and green bar are going to shift at June 30. The board adopted new ranges for next year. So where we're kind of under and over allocated, those will be corrected. Long term, though, our core, I always point out to new employees the little slivers at the top of the pie chart, inflation sensitive, and what right now is still called absolute return, but as of June 30 will be renamed RMS. Those two little slivers are expected to grow over the next 5 years, and you're going to see the portfolio shift in that direction. We're also continuing to try and grow private equity a bit and real estate down a bit, but we recognize market conditions, and now is not the time to be buying into private equity in mass because prices are so high. Here's a good look at the Russell 3000. So this is the U.S. stock market on our fiscal year. So again, our year starts at July 1 and goes to June 30. It has been a heck of a roller coaster year, and it's been a heck of a tough year to figure out this market. We've had two big drops last summer, and then obviously I always point out February 14, Valentine's Day was kind of the market low so far this year. We've had a very nice rally since Valentine's Day. But overall, we're kind of ending up almost right now where we started the year. Most people would look at that and say, well, you had a really boring year. Well, I look at that and say, that's a lot of Tagament and Maalox and antacid in between there, I got to tell you.
I remember January.
Yeah, January was sleepless nights. So tough times, a tough year in the market. And that'll be the kind of thing where everybody has a ho-hum, but I'll be coming to you and saying, actually, it was a really stressful year. Let's step back and look at the market over a 3-year period. So I really put in the low bar and the high bar, not being true technical charting, but just to give you a rough idea that really since about the middle of 14, the market's kind of been in this trading range. It has lost momentum. If I back this up 5 years, you would see that the market had a huge run up from 2009 all the way up to 15. It's not that the rally has ended, but you certainly can see it has topped out. It has lost momentum, and the market is really kind of seesawing in this range. So it doesn't mean you could trade this range that, I'll sell when the Russell 3000 gets up high and buy when it's low. But you can see the kind of volatility all the way back, in 14 and 15 that we've been experiencing. So climbing up the crow's nest and looking out into the future, the black swan events, as it were, on the other side. Obviously, the China slowdown. We were very vocal that we think China is, frankly, in a recession. It'll never show a negative number, but the internal dynamics of China look like almost a recession. There is still continued concern about internet hacking, particularly as it relates to financial institutions in Wall Street. Brexit, June 23rd. Stay tuned. We saw a survey about a week ago that said, it's pretty much not that controversial. They're going to vote to stay in. Then we saw one just a week ago that said, now it's 50-50. So you just really don't know with the British till they head to the polls and how they're going to end up and vote. The U.S. presidential elections, obviously the two candidates are decided. Some of you might be happy about that. Some of you might be very disappointed. But that's still going to be a huge overhang in the market because there's just so much divisiveness, so much rhetoric, so much just combativeness going on. And the positions are so radically different in terms of, does Janet Yellen stay on or not? Regulation, no regulation, anti-Wall Street. But that's just going to play as kind of a black swan and short-term events in the market. And the other ones. The positives are actually getting far and few between, but they're important. GDP is growing, not a lot, but it's growing, and we have historically low interest rates. So 2 things I want to finish off with, 3 things, that I want to finish off with. If you look at INV 27, I want to congratulate or thank Josh Diedisch and his team. I believe Tom Unterman asked for this information. Great chart that shows our portfolio. In the black, it lists where our portfolio is allocated, but in the green, it shows you where the revenues as our portfolio. So when you think from a revenue standpoint of how much does our portfolio make when the U.S. economy is doing well, only about 50% of our portfolio benefits from the U.S. economy, even though that's 74% of our assets. So what that tells you is, as we know, U.S. companies are incredibly diverse. Apple is not a U.S. company. Coca-Cola, IBM, all get their revenues from around the world. To help you just sort of digest, I think it's a fun chart visually to look at, but if you turn the page to INV 28 at the top, what Josh and the team did very conveniently for you is then rank them. What are the top countries in the first? How the countries rank from top to bottom in terms of our dollar exposure, but in the next column, they show you where the public equity revenue is coming from. So the UK is important to us. We care about Brexit, but it's only about the 4th, from a revenue standpoint, it's only about the 4th most important economy. Who's number 2? It really does. That shocked me as well. That China's a very small exposure, but that darn economy matters a ton to us. And so when I say it's slowing down, equity exposure to their market is low, but revenue exposure. So a good classic company would be Yum Brands. One of my favorites, I hate to admit it, Taco Bell. I'm not allowed to eat there much anymore, but KFC, and Taco Bell. Yum Brands is almost entirely dominated with their locations in China, but it trades in the USA. Alibaba trades in the USA, but obviously a Chinese company. So very interesting. Another one that might surprise you is Italy. Surprised me. 18th in our country rank, but number 10 in our economic exposure. You know, and the flip side is Switzerland, not surprising. Switzerland's a very large portfolio exposure, but very unimportant when it comes to revenue because it's a small country, but it is the banking capital of the world. So I think some interesting stats as they slice and dice the portfolio. I always like to highlight INV 29 so that you're really looking at where is our asset classes. This is by asset class. The top two bars are by exposure to company or country. The bottom two are exposure to manager. So even though we have a 4.25% exposure to Blackstone in private equity, Blackstone owns, you know, over usually 18 to 20 companies per partnership, and we have multiple partnerships. So that's actually like probably 40 companies. Whereas that almost 1 3/4 exposure to Apple is 1 3/4 to Apple. So go home tonight and download some stuff, please. But it cracks me up. If you've heard the expression FANG, the FANG stocks, Facebook, Apple, Netflix, and Google. Google is Apple now. So FANG, you'll hear that term a lot on the radio and the financial radios, FANG stocks. But, it really is surprising. I mean, we hear a lot about ExxonMobil. You think about IBM as being really critically important, what the old Dow 30 stocks. But it is Apple, Alphabet, which is the new name for Google's parent, Microsoft, Facebook, are all right there in our top 10, and those are obviously social media companies that were not that important that long ago. So let me finish off with, and there's some really good valuation stuff in that risk report by Josh. Two things I want to do is recognize some people, if you would give me the time. First, I'm not going to lift this trophy up again. It hurts. No, I will. But just for the audience in the back. It's heavy, June. We received, CalSTRS received the 10th Anniversary Founders Award. Harry was there and received the award on our behalf from the Asian American Investment Management Association. We and that other fund across the river, not Sacramento County, but that other fund that Alan mentioned, received the award. But I think it's a recognition, you have encouraged us to work very hard in diversity, and it was very nice to receive this as really recognition that we were there as part of their founding. So pass that around. So that was awesome night.
It's like a heavy or something.
It blasts.
Awesome. Very cool.
Hey, the other thing I want to let you know about, and I'm really excited about this. A couple of years ago, changes were made to how you could use students, and kind of our student program was literally wiped off the map. If you recall, last few summers, I've been able to afford in the budget one student to be a shadow for me as a CIO, or two students. This year, Sandra Teague and her staff really worked hard. We worked it out of the budget so that we could afford 8 students, and we have launched the first official summer investment intern program. We advertised at UC Davis, Sac State, the community colleges, and we got over 170 applications from students. They narrowed it down to 8 students, which we're doing in 2 cohorts, kind of a green team, because the schools are on very different summer systems. So the CSU schools are out, but UC is just getting out. But I want to recognize 3 of our students who are here today. And one is shadowing me. So the first is I'm going to recognize Monica Wan. Stand up, Monica. Monica is, I've introduced her to many of you. She is a third-year student at UC Berkeley, with environmental econ major. Go Bears. Dana is a big Bears fan. And then in the back of the room, Tyler Ma. Tyler is a business admin major at CSU Sacramento. And Ramon Hernandez is a finance econ major at CSU Sacramento. So.
Right on, welcome.
Love it. Awesome.
Well, and I want to give a shout out because Sharon, you'll appreciate this. In the back of the room, if you could stand up, Jacob Thompson, Folsom Lake Community College, just got his finishing up his
CC's in the
AA.
house.
He's going to go to Sac State in the fall. He took time off on his 1 week summer vacation. He just left his other job and he starts for us on Monday. But he came here to the meeting. So
Awesome.
Jacob
Welcome.
Thompson.
Yay!
I have to say that we're just happy to see community college students transferring to four-year colleges because that's one of our objectives. So that's
Yay.
awesome. Yay.
So then in next week, starting next week, we actually have 3 UC Davis students starting up, and I'll introduce them to you in the fall. In July.
Awesome.
They'll be back at school in the fall. And then lastly, Sharon asked me to recognize and ask Dilo Shavanazzi to come forward. Dilo has just done, as you know, she has decided to retire a bit early. She has done a fantastic job of building up.
There she is.
There she is, coming in from the outside. Dilo has just done a fantastic job of building up our infrastructure program. If you didn't know, Dilo, we recruited her away from CalPERS. She had built their timber portfolio working under Russell Reed and Mark Anson, and we were able to pull her over here into private equity. And then when the board created the fixed asset financing program, which we now call infrastructure, Dilo competed for that job and became portfolio manager and has built the policies and built that portfolio up from the ground up to what today is, almost a $2 billion portfolio. And I can't help but contrast. We did that with a smaller staff with about 5 people, a lot of help from PCA and Makita, compared to our friends across the river who have a similar size portfolio and have a staff of 9. I'll take our portfolio over theirs any day in infrastructure. So we just wish Dilo the best. She's got 2 twin boys who are, almost driving age?
Almost. 16.
And hope we can convince her to come back out of retirement. I think those 2 twin boys are going to help us a lot in terms of convincing her to come back here. So.
Awesome. Dilo, I did ask Chris, I know that you're a very demure person who doesn't like attention, but I did ask, if we could just tangibly thank you and have you in the room because, again, I feel like with Gretchen and then with you, it's like you're one of the first people I interacted with when I was first on the board. And I think with infrastructure, it's been a space that I think we've learned a lot from. It's new. And to see you, a woman of color, be in such a place of stature, as well as the times that you've helped me understand infrastructure and taken the time to meet with me and come to conferences. And it's just been, it's been really meaningful. Again, I feel like it's another testament of the quality of staff that CalSTRS attracts. And so we wish you the best with your family and the other things that you're doing. And I secretly hope with Chris that someday, this is not goodbye. This is just wow or something. But we just wish you well. Just can't say enough good things about you, Dilo, and we wish you all the best. So. Thanks for being willing to come in personally and receive that. So take care.
And with that, I'm open to any questions.
Let me see if I have any. Nobody's in the queue, so
Nope, I'm good.
I think we're good. Thank you, Chris. Appreciate it. All right. Now moving on to item 5, our special mandates policy. This is the first.
As I said, my name was on this agenda way too much.
I know you're very popular on this agenda, and this is a first reading. As with a lot of our readings, we can switch it from an information item to an action item if it's the will of the investment committee. So we'll just kind of take it as it comes.
It's knocked over my soda, so
I hate when
to
that
avoid
happens.
being electrocuted.
I hate when that happens.
So the subcommittee on the investment committee started meeting in December, and they first thing I think that was brought up was, hey, do we actually have a governance mechanism for bringing up issues like these special mandates that you tasked them to study? And we kind of talked about, well, we had sort of things, but we didn't have a clear policy. As the committee continued to meet, it really became quite clear there were lots of special mandates. We've never really identified them as that. and then the interest of, you know what, we need a set policy on that. So the committee had a first reading. Thank you, Muriel. That wouldn't surprise my family. I'm a spaz. Knock everything over. The committee had a first reading at the May meeting. Did some changes to the policy. They tasked two committee members to work with staff to kind of hone it in. They wanted to present it to you as a first reading now because they also realized they don't meet again until December, so there's a big break for them, but then also you meet in July and then you won't meet again until September. So sort of recognize the schedule. They wanted to finish it up and bring it up to you. The policy tries to outline very clearly, and as you can see on INV 33, we've had a fairly long history of what I will call special mandates or board member ideas for investments dating all the way back to the 80s, when it started with a home loan program for the members. Some have become kind of part of the minutes, were part of asset allocation shifts or program shifts of, hey, we're shifting out of this, going into that. What if we carve out some percent and it goes there? The committee wanted to be very clear that the policy should dictate what is the special mandate, why do we think it fits in our asset allocation, where's the money going to come from? And so I want to make it clear, this isn't, if a board member has a policy idea or a change to a policy, this doesn't come into context here. This is only when a board member thinks we ought to invest money in a specific new idea. Council and fiduciary council had asked me, well, how is that different than the investment staff? Our discretion is limited by the policy. So we can do things that are within the investment policy, but if we had a special mandate, we would come to you. And particularly people have questioned, well, what about the gender index? Well, the gender index is an enhanced index, which we felt fell within the policy. It was not a unique thing because there's a very tight tracking error. If we said that we think we need to invest now in, I think I said it yesterday, companies that start with the letter B, I think we would have to come to you outside of, we're going to hire managers that only do that, and we would set it up like anything else as a section of the asset class and part of a policy, and we execute as part of the policy.
Chris, I'm going to let Harry jump in.
I'll let Chris finish his, and then...
No, I was about to say, so I think that gives you the context of why the committee wanted it. There was a lot of good vetting about, and I think probably the best thing that we've done here for governance overall for all of us is create a repeat evaluation process. You can see a lot of these ideas were bubbled up in 2002, 2003, and 2004. While they're constantly evaluated and they are constantly reported to you as part of the semi-annual reports, they're small enough that they don't bubble up to their own separate section or their own separate deep dive, but they really warrant that. And in many cases, I can tell you what was intended as the economic theory behind doing it. Not surprisingly, in 15 years or 13 years, that's changed. And does that theory still hold? So it automatically forces all of us to go through a good refresher and reevaluation, and it brings in the consultants as an independent third party to come in and reevaluate, because when a board member recommends an idea to us, that has a lot of weight. And it's tough to us to come back and say, well, that idea doesn't work well. It's easier, not as easy, but it's easier for the consultants to be a bit more independent. So that's the intent behind the reporting cycle. It's not intended to add more reports, but to evaluate the performance.
Harry?
Thanks, Ms. Hendricks. Chris, thanks for the work on the policy to you and your staff. Appreciate Mr. Rosensteel and Mr. Unterman contributing to getting it to this point. Before I comment on that, I appreciate you explicitly stating that this is for the board and that the delegated authority to staff is significant enough that you could, for all intents and purposes, pursue a strategy or something similar to the gender index that would not be subject to this policy. I would just ask that maybe we work a little bit closer in the future in terms of awareness and things like that, in terms of communications. But the intent wasn't for this policy to detract from the delegated authority we currently have to staff, if that's clear.
Yes, no,
So-
and I think I recognize that we need to come back to you. We have talked internally about increasing the enhanced indexing portfolio. There are new products like things that are based on the value index or different characteristics that we think are particularly interesting, governance indexes, things like that, just to make sure you're aware that we're pursuing it and that we think why it fits within the policy.
And specifically to the policy that's before us, I think this does a good job in terms of on INV 37, N2, Nancy 2, annually, it talks about ancillary special mandates, a report that shows the risks and cost-adjusted performance. I think that's a healthy addition. But I do have a question around the 3-year anniversary and the 6-year of the periods where essentially it will be evaluated. What's the rationale behind the 3 and 6 year period? Why wasn't it 2 and 4 or something? And
It's tough to call it an exact time. 3 years I came up with because that used to be considered about a market cycle. When you would ask a manager over what time period can you evaluate me, like a public equity strategy, it would be well over a market cycle. How long is that? Oh, 3 to 5 years. So we thought that might be the most fitting. 2 years, oftentimes in these strategies, it takes time to implement, and you're only looking at about 18 months of performance. You wouldn't have enough time period to really know, has this worked or not?
Thanks. I think the policy explicitly states what a special mandate is, which is terrific, puts that in place. Secondly, it talks about who can initiate a special mandate, outlines a process that has to be followed, and then puts in a time period for which the mandates would be evaluated as to their effectiveness and the cost to the fund or the added value that they've provided. So absent any objection to this policy being adopted today, I would move it as an action item for adoption.
Second.
We've got a few folks in the queue, so it's been moved and seconded, and I'm going to take the next 3 folks and go from there. Frank?
I had a question on the vote thresholds. In order to be added to the work plan, the policy says a majority votes required, but in order to be actually integrated into the portfolio, it just says approved by the investment committee. And same for the 6-year review time frame. It just says if approved by the committee. I was wondering, do you mean majority vote for both of those?
Yeah, I mean, the committee's bylaws say just simple majority votes. We could say that consistently, keep it all consistent throughout. Right? Approval of the investment committee, which is a majority.
Dana?
So, Chris, some language suggestions, or a language suggestion. I think that the procedure is clearly delineated, that the investment committee gets a written evaluation, and it contains the elements A through F. We move on to 3, 4. Because that is so clear that we get the written evaluation, we have the discussion, gets put on the work plan, then it seems to me that we don't need to necessarily start out the introduction on 2 in a negative manner.
Okay.
So I think that it's a redundancy that we don't need, and I would rather couch what we're going to do in positive terms. So just the investment committee will receive a written evaluation. It includes A through F. We're not going to go forward unless all those things meet what we want it to have, and that's already stated in 3 and 4. You good with that?
Yeah, it
Okay.
sounds good to me.
Alrighty.
It's you.
And then I'm curious about why, instead of using the true initial funding date, we would use the date that the policy was adopted. Why couldn't we leave what those initial dates were and just have them included in the review as of the date the policy goes into?
Add 3 and 6 years and just
I-
come around. I'm fine
yeah,
with that. I just didn't want to load up your year once you adopted this, so it's up to you. up to the committee on how you want to do it. But you're right, we could easily divide it out by 3 and 6 and figure out where we are in the cycle on these.
Because I don't want to lose the dates that we actually got involved in them, and by
Okay.
changing that initial funding date, you know what I mean?
Yep.
Okay. And as long as the committee agrees with that, I'm
Committee amenable with those edits?
making
changes?
those amendments to
Okay.
the motion.
So that sounds good. You good, Dana? Mm-hmm. Okay. Lynn?
I just had a question on page INV 36, under section 1. It says that the board member proposing this would have to explain to the board a theory, including any anticipated economic justification for the special mandate. And is that, is the board member expected to have a full-on financial analysis, or is it just I believe that this would be successful because blah, blah, blah?
Good question. Because we could be throwing out ideas all the time, Chris.
I'll share my
basket of them.
perspective, which is, I think the committee was, and what has happened in the past is people have said sort of like, I believe, not a belief statement, but I believe that investing in urban and rural California will add value. There's not enough capital there. Sometimes the board says, let's go to the point of studying that. But even then, most of the beliefs I would tell you, because I lived through a lot of these, there wasn't much empirical data to support investing or not. We tried to go find people that had done things. In a lot of cases, it's a brand new idea. And so I think, from that's what I'm expressing, what I think the committee was thinking, but it's really up to you as to how hard you want to make it on each other, as to, a dissertation or
That's a
just
good
a belief.
Thank you. I think that works from our perspective.
Yeah, absolutely. I think that's. Joy?
So, Chris, in the proposed policy, among the things that I think will be part of the analysis is an analysis and recommendation on a proposed source of funding for a proposed special mandate. It then, kind of goes on to say that if it's approved, the mandate will be integrated into the portfolio with the capital allocation. Will the recommendation from the staff come with both the source of funding and a recommended allocation, or is that something that will be just considered more generally by the investment committee?
No, I think that would be that would fall under our role, that we would have to come back. And when I look at the past ones, the committee usually double checked with PCA and with staff of, we're thinking about this. Does that make sense to you? And we would normally come back in and say, because it's a shift. So one example, I would focus on the Global Equity Program. We in the subcommittee had that discussion. Where did the corporate governance activist managers come from? When you go back and look at the March 03 agenda, you realize the board was making a shift into active management and said, we're shifting 10%. What if we take half of that and allocate it to activist managers and half to developing managers? So it wasn't kind of a formal thing. It was more of a debate and a discussion, and staff and PCA acknowledged they were fine with that. So it would be that kind of presentation, but it would be the exact amount and a clear recommendation.
Thank you.
Great, thanks. That's all we have in the queue. So it is a first reading, but we've had a motion to approve the special mandates policies with the edits that Ms. Dillon suggested, and it's been seconded. So all those in favor say aye.
Aye.
Opposed? Abstentions? You have your special mandates policy approved. Thanks, Chris. Tom?
Yeah, just 2 footnotes on this. Now that we have a policy, the committee that studied the policy also invited the staff to make a recommendation as to a special mandate within the sustainability investing area, and they're working on it. But to follow the policy, I think we now have to request that they do it. So I'm requesting that at this point, so that we have a predicate for discussing it in July. I'm learning the bureaucraties here that we're creating.
I know. Welcome to the public sector, my friend.
And otherwise they'd be at a loss in July. Because, anyway, I also want to invite them, the staff, particularly the private equity and the emerging manager group, to look at another very small special mandate, and that is investing in new technologies affecting schools and teaching. And the reason I'm suggesting that is it was a very robust area of investing at different points in the venture cycles. And the deal flow still continues, but the constituency to invest in it has dropped away. And some of the opportunities have really been very attractive. For example, lynda.com could not get funding, and it became $1 billion plus exit. I think if we were to find somebody with a relatively small commitment, or if they wanted to study that and see if they would make a recommendation there, that would be helpful. It would not have, I think it would best be benign in terms of material impact on our investment returns. It would probably not be negative. And on the other hand, it is something that's a direct interest to our core constituency, and I think could do a lot to make their lives better.
It is, I'm going to add before Margot makes a comment, it is an area that has warranted a lot of discussion with our constituent groups, because the disruption, the potential of disruption coming to the classroom, there are some groups that are very concerned about how that would impact teacher employment. On the other hand, it's embraced. So I would say from us as a staff, because we're not educators, it's tough for us to figure out, is that innovation a good thing or is that a disruptor? So obviously, you know, if you're a taxi driver, you're probably not too thrilled with Uber. But when is it an enhancement and when is it a detriment? But I understand what you're saying, and Margot probably has a comment. We were an investor in Lynda because one of our private equity firms owned it, but I couldn't figure out if that was a good thing or a bad thing.
Yeah, bought it. But I mean, she went for years without. So I would just say, just also note, I should have said it as I did this, that when I was in the venture business and actively looking at deals, I would probably get an interesting idea every 2 or 3 months from a teacher. And so it's more that I'm thinking of than how do we do distance learning so nobody has to be in the classroom.
Right.
I was just going to add that work is in progress. We've met with or talked to one of our venture capital partners for ideas on how to approach this, and we'll get back to you. We're in early stages of looking at it.
Awesome. Thanks, Margot.
And we also, Tom, we also have it on the research agenda, and Dana and Sharon met with me on the work plan for the year, so in July we'll talk about it, but not from an investment perspective, but we want to start looking at this in terms of how it relates to work patterns and how would it affect potential retirement issues, since it seems to be growing in attention. So we're going to have a focused research project on this as well this year.
Good.
Yeah. Harry?
I think it's been covered. I think, it's been covered. It's a very fascinating space that we can help a lot of teachers and help schools and help public education. And at the same time, we probably can have a little education around ourselves, around those technologies and efforts to dismantle. We don't want to be in that space, but we, to the extent that we can be, and I know Tom's intentions are here is to help teachers and help kids and help public schools, and there might be a way that we can do that from an investment perspective. So I support his suggestion that we begin to explore that. And if I heard Ms. Worth appropriately, they're already looking at some opportunities. So I guess more will be revealed, as they say.
Yeah. Seems like it's about innovation and supplementation versus obviously like Tom said, replacing classroom, teachers, but it's all about innovation. And I think educators were always interested in ways to help students learn in new and different ways and creative ways. So I think that's certainly something interesting for us to look at. Paul?
It'd be exciting.
Yeah, totally.
So I'm just trying to understand where we are then in our process that we just now adopted, because the procedure we now adopted is that at an investment committee meeting, a committee member may identify a proposal as a special mandate subject to this policy and initiate the following procedure, which is that if the investment committee agrees, then at the next investment committee meeting, we would add that to the work plan if that member who proposed the special mandate comes with an explanation of the economic justification for it. And then if it's added to the work plan, then the staff would come back at a subsequent meeting, and it's all very clear that it's these 3 different meetings. I'm just telling you, I mean.
Right. So you're basically holding us to the process, which is fair.
Well, I'm just,
Yeah.
I suppose we can modify
No.
but I think,
It's legitimate.
I mean, in other words, I think it was Lynn's question and Chris's answer, which is that we've tried to establish a process that, says if we're going to do the kind of research we should do on any of these special mandates, then it gets added to the work plan for there to be, we make a decision to add it to the work plan. And I think that's appropriate. I have no problem with this, but I think we've got so that we protect against everybody just saying, well, gee, I want to invest in this, and I think that's a great idea and stuff like that. So.
Got it.
So I agree. So what I was intending to do with the first suggestion is maybe leapfrog some of the steps in the policy, because we did have the special committee of the full board working and doing that, and anticipated that issue would be considered sort of in parallel with the policy. With the second, I'm intending to start the policy process, but in fairness, I should disclose it's something I suggested a while ago, so the staff has been doing some thought, giving it some thought.
Well, we're in process right now.
Yeah.
So.
No, and I
So-
think with respect to the first one, having
Right.
to set up a subcommittee, I think, kind of added it to the work plan.
Right.
Right.
By definition, acknowledge that.
So with the second piece, Chris, just to kind of, I guess, to model, given we're in a process and learning in it, is the process then for it to be added to the work plan until, or help me with the second part of Tom's request. What's the next step?
Because to us, the real key to trigger the policy is when somebody says, I think we ought to put money or invest in a particular idea. What Tom has suggested is to us at this point has been, let's create a pipeline so that when teachers have ideas, we have GPs to send them to, rather than a dedicated venture capital fund just for our members. If that was the proposal, I would have said, let's trigger the policy and go through the proper procedure. Margot is at this point exploring, hey, is there a lot of stuff going in this area? Which of our partners are good to talk to? Should we just really set up a kind of a referral line for people?
So that's different than what I guess I initially understood that Tom was requesting. So it's a pipeline for
That's what we're
educators
working
when
on
they
right now.
have ideas. Is
If we
that
want a
accurate, Tom?
dedicated allocation to that strategy, then I would say we need to trigger the policy.
Tom, do you want to?
That resolution would be fine if we find out that there is such a home. My guess is the other result could be that it would be such a small allocation that we'd find it within the staff's delegated authority, and that would be that. But so I'm happy to have them study and explore it, and we'll see where it goes. And if it means adding it to the work plan and holding all of the required discussions that we're going to have before someone can invest $2 million in a software idea that a teacher in El Segundo has, fine.
Sure. Mr. Keeley, did you have?
Yeah, I just think this could also maybe fall under a information request that we're
Right.
requesting
That's what I was thinking,
information from the staff on opportunities and areas in this space, and just educating us a little bit, and then rather than, I think we're not talking about a big thing here. Just it's an idea that a board member has surfaced that
we're not saying to do anything at this point. We want some information, and potentially could be a very, very exciting idea and
Totally.
opportunity.
Energizing.
That is well within the delegated authority of our staff to do and implement and come back and report to us. I think it's also, as Dina said, there's some other issues going on in this area
Right.
that we're going to have to educate ourselves around. So,
Sure.
yeah,
Yeah.
certainly.
And I would
And-
just to emphasize again for Tom specifically, I think what we have found is, as from an investment perspective, what we think is really cool and neat, it might be really good. Then when we chat with a few stakeholders, we realize that that is just an awful, hated, terrible thing. We better not have money there. So it's kind of like, oh, whoa, as we've experienced with this board in other areas within education, you are experts in education, we're experts in investments. So we just need to really tread carefully because our members care about the education field passionately.
Absolutely. And we'll be thoughtful and considerate as we always are. Lamont, did you get that as an information item in general, capture the spirit? Okay. So we are making it sounds like we're making that an information item request, information request. Okay. All right, we're moving on to item 6, our private equity.